guys, so moving on to a sweet formation that I would like to just share with everybody. This is from the old Astro content. This was 3.5 years old, I believe. I'm 3.5 years old. It's called the 3-pin formation. If I just pull up a fresh chart, let's go with the Aussie dollar. Okay, Aussie. If I just go into tools, remove. Let's have a look at the daily for a second. Aussie has been a bit of a mess recently. Okay, so this formation called the 3-pin formation. There's one right here. 1, 2, 3. The 3-pin formation takes 3 candlesticks. What I like to do quickly is open. It takes 3 candlesticks. Let's start here. So we have one 3-pin formation. This is the Canadian. This is a screenshot. When was this from? 28th of the 4th. This was 28th of April 2018. This is last year. So we have 1 high, 2 high, 3 high. So it takes 3 candlesticks to make the 3-pin formation. This is a bearish rollover example. The bullish is vice versa. I will go into this on the chart in a moment if I can find one. After the 3rd candlestick closure, so here we have market pushes up. Alright, again, has a miniature little push up there. This is the 4-hour time frame. On the closure of the 3rd candle at 2.9 in this example, is more or less the short opportunity. So you sell after the 3-pin formation. So you get 1 high. The middle wick is the tallest. 3rd is the one that is lower than the middle. This looks like this over here. So we get a higher high. So if I just collage this for a second. So the market pushes up. So this is a 4-hour. This is how it will look on a hourly chart, hourly time frame. So the market pushes up, makes a new, let's say, higher high in whichever formation, or a new significant high. That's the wick. Where the market closes, the body makes a higher low. Then the market thrusts all the way up into the higher high, significant high / turning point, which is the middle wick. So that's the left wick, middle wick, and then this is the 3rd wick here. So what happens is the high is made, the market trails all the way back down to form where the body closes right there. Then the market pulls back up for another, let's say, lower swing high, or it could be a right shoulder right here. Then, boom, the closure of the body, which is there in this case, official lower body, 3rd candle body closure. This is the market execution. So, recap, we get the market running up into the high right here. The pullback, the higher low, is the body. The open then pushes all the way into the high, then comes back to the low right here. Significant high turning point, new first low. The market pulls back into a right shoulder right here, new lower swing high there. Then the official lower low, 3rd candle body closure, market execution is there. So what this represents, the 3 pins, guys, the best time frames, daily and 4-hourly. Daily and 4-hourly. You can use this structure if you do spot it on a monthly and a weekly to give you the bias of the next month or next week ahead. But for execution purposes, please stick to the daily time frame and the 4-hourly. It's a good little trick to have in it's a good little trick to have up the sleeve in Arsenal. But this is what it means right here. So you can screenshot that, write it out, do whatever you will. So in execution, on the 3rd candle closure, we execute. We track the high, bang on with the crosshair. So this looks as if it may be like 2940. 2940, we had the resistance level there too, so it's always good when we combine it with a fib level, a resistance level. Market rolls back to the downside. The third candle closure is where we execute. In this case, the stop loss goes above the middle point. These older rules on the 28th of the 4th, 2018, I did state 25 pips above would be ideal. However, we can change that. Let's do 5 pips above. So if you execute at 2905, the high of the wick is 2940, our stop loss would go at 2945. Nice and tight. This is a little bit too wide. We can bring it down to be a little bit more conservative, and that will get us a better risk-reward profile. So 5 pips above the top wick. Again, you can screenshot this as well. So over here, I would show you what the risk-reward sentiment looks like. Right, let's say we're going for the lows as a target projection. With the 3-pin formation, let's say we have 7,300 as one key area, key zone. We come up into that region, we cannot break it, we cannot breach it. 3-pin formation on the daily is formed. 1, 2, 3. Let's pull this back up. 1, 2, 3. So the market, we start here, we start at the open, we push all the way up, we make a high where the wick is, higher high. We pull back to close at the body, here. Market runs, rallies right back to the highs, creates the wick. Market then pulls back, okay, to the body. Next, this day, the market flails around a little bit, but however, it does come in and bring us a new lower swing high, which is there. So 1, 2, and then 3. Then the official lower body third candle closure is right here. And that's where we would execute the trade. In the scope of a short position, let's have a look right there. Right, so there's the high. The high comes in at let's just say 95. Stop loss 5 pips above. You can put spread in there as well. Might give us 7 or 8. We can maybe go to 7302, and our target can be at this lower end as well, already marked on. Or obviously, this is going to change time and time again in relation to market setup, market sentiment, structure, whatever we see, overall bias. 55 pips to 161 pips. Risk reward of 1 to 2.9, nearly a 1 to 3 risk reward. That's how you would lay it out. You want to keep the stops nice and tight. By the way, if you guys are new to the risk reward tool, later on trade management video, I'll break this tool down. I'll give you an idea as to how to use it, what all of the numbers mean, and a few trade management ideas as well. How I would approach a medium-term trade. So if you don't understand this just yet, once you've got to the end of the first section, come back, reevaluate, and you will see how this is actually put together and formed. Aussie price action has been a little bit drastic. We do have another one over here as well. 1, 2, and then 3. 1, 2, 3, body closure. That would be an entry. Stop would have to be up here. Again, it is above 7.3 as well. We see where the market has tapped 7.3. Orders have came in, rolled over, came back into these lows. So that's looking like a pretty decent 3-pin formation risk reward setup there. Let's get rid of the Aussie for a moment now. Let's go into USD CAD. 3-pin formation. Can we see any up here on the 4-hourly? Yes. 1, 2, 3. 1, 2, 3. This is what this one would look like. Short setup. So we have the highs right there. 1.3450, 5 to 7 pips above, including spread. Let's go to 57. 1, 2, 3, pulling it down to the low target zone right there. That's a risk reward of just shy of 1 to 2, 1 to 1.9, 29 pip stop, 56 pip gain. That's how you would approach that. It's also come off a confluence of 3, 450. As you can see, the orders tapped, market reverses, rolls over, 3 pin, 1, 2, 3. A little bit of breathing room there as well, nice and tight, and then news pushed that market down to the base area of support. Over here we have some more. We have 1, 2, and then 3. 1, 2, 3. This is what this one would look like. High is in at 66, 71, 70. Let's do 73, including 3 pip spread there. Market wherever you need to go with that one. Well, that would be that. Stop's only for 47 pips, so we want at least a 1-to-1 risk reward, going for 47, 50 pips right there. A 1 to 2 would obviously be 100. That's how that one would be approached. GA. Do we have any on GA we could look at? Sell the daily. I mean, these, we can see some over here. 1, 2, 3, where the market came below 8.4, retested 8.4. We have 1, 2, and then 3 there on the body closure. Any others? It's not something that you're going to see every single day in the market, but it is something that if you do spot it, it does hold high probability, and you are going to spot this at key levels, support and resistance. We have 1, 2, 3 on the bullish side of things right here. 1, 2, 3. Market pulls back up. So I just wanted to redo the video from the old content, because I know some people do like this. I didn't really want to leave this out. We have 1, 2, and 3. That is still a considered 3-pin formation. 1, 2, 3. Carves out the bottom. Okay, spikes into the trend line. We also have the break of structure here. 1, 2, 3. Again, right there. Market pulls up, consolidates, pulls up, consolidates. 1, 2, 3 there as well. Oil is on its way to 64, 65. Awesome. And this stuff can also be used on crypto charts as well. 3-pin on the BTC chart. See if we can spot one. No. One here. 1, 2, 3. Middle is larger than the left. Middle is larger than the right. See, the moving averages played a big role here on the BTC. Called that entire move on the VIP members for the Cryptonary channel. Again, using similar concepts. Let's have a look at CAD on the day. Anything on the day here? 1, 2, 3. In such a move, obviously that risk reward probably won't make too much sense. That's 100 and something pip stop loss. We have to be realistic with this. Same with this here, 2, 1, 2, and 3. But the 3-pin formation, guys, the areas in which the 3-pin formation, when it comes down to the wick highs, down to the bodies, these are solid areas of key, the key levels for the ranges and the regions. So even across here we could maybe use that. So where we see the 3-pin formations form, whether it be the bullish side of things or the bearish side of things, just know, due to what's happening on the lower time frames with the structure, i.e. here, that this is a significant area for supply and demand when it comes down to the ranges. So just remember that. So as you can see, we're stretching this all the way across now, and it has been used right here, and then also right here on the back end of yesterday, has been used quite a lot for supply and demand. So 3-pin formation, I just wanted to drop it in there. I'm going to wrap up this video now. Again, you can go ahead, take a screenshot of this, going back in time. And so, going back in time with this, that's what it looks like, and then vice versa on the flip side. So if we looked at this on the daily and the 4-hourly, on the hourly time frame, when we zoom in, it would look like a mini Head and Shoulders or an inverse Head and Shoulders. That's the best way to put this. Thanks.
I just want to go back.